Hi, my name is Jack Petrick. I'm a full-time multifamily apartment investor. Wanted to provide a very brief video explaining the investment opportunity in my background. My number is listed right here, 440-552-8483. And please feel free to reach out to me with any questions you have on the opportunity. My background, I was a firefighter for the city of Strongsville for 15 years. I've got 16 years invested as a real estate investor. I started off building custom homes. We did a lot of general contracting work, transitioned to single family rentals, and some Florida vacation rentals. And currently, to date, I have 217 rental units with basically this mix down here. When I started building custom homes, these were examples of a few homes that I built. I did this until the housing market crashed. When that happened, I transitioned at that point to picking up single-family rental properties because of the price points. This is one of many houses we purchased for $4,000. We are all in at $45,000, and today they're worth $85,000. As far as apartments, we are looking for value-add apartments where we can force the value of the building up by making improvements to the operations of the property, by raising rents and lowering expenses. So we're intentionally looking for properties that have low rents, low occupancy, deferred maintenance, poor management, burnout landlords. Everything we buy is going to have a distress or a low cap rate going into the deal because the financials are running inefficiently. So we're looking to improve the net operating income of the property by increasing income and lowering expenses. And commercial real estate is valued based upon the NOI that it generates. So for example, I've got a 16-unit building. We took the rents from $650 to $900 a month. We had a $250 a month increase times 16 units times 12 months is $48,000 of additional revenue per year. If I take that $48,000 and divide by an 8 cap, then I just increased the value of this apartment building by $600,000. We can also add, pet fees, garage carport fees, interior locker storage fees, laundry income. We're also looking to improve our NOI by reducing expenses through reduction of energy costs, reducing water usage, and just installing better quality materials so it reduces our turnover expense. These are just going to be a few examples of some buildings that we currently own and currently are under renovation or have been renovated. This is a 16-unit building. Rents were at $650, and we were able to take the rents up to $900 a month. Rents were at $395 a month in this property. We also were 50% vacant, and we have rents actually between $625 to $650 upon a relatively extensive renovation of the property. This one over to the left here, this was a hoarder's unit, but we had a lot of really distressed units renting at $395 a month, and we were able to get those up to $650 a month. This is the property in the city of Lorain. Rents were at $450 a month. We did a light renovation. We took them up to $595. This is the property in the city of Parma that we're currently remodeling. The net operating income is $44,000. One bedroom was running at $460 a month, and we're going to have the NOI up to $100,000. One bedroom to be renting at $725 a month. This is a property at Brook Park. One bedrooms are going for $560 a month, and we're going to be taking those up to $750 a month upon the renovation of the project. And basically, again, just going over again on those properties, these are properties where we have to renovate and improve the cash flow and have a competitive advantage. And most apartment buildings in our market are very old and very distressed. And we're providing a really nice product to the market. Very briefly, I'm going to go over the areas of responsibilities that my team and I cover. Please feel free to pause the video to review the list. I'm going to go quickly through them just to keep this video a little bit shorter. But we take care of the entire operations from the point of finding deal, putting the earnest money down, going all the way through, closing it, managing it, leasing it, remodeling it. We do everything in-house. This is what we do during the deal flow phase of finding these deals and analyzing them, and also just taking to our lenders and verifying that the deals allow us to be able to improve our NOI, refinance, and be able to cash our investors out. These are a lot of the items that we're doing during the due diligence stage. This are just a lot of the items we're doing during the closing phase of the property. Just a lot of the work we're doing on the operations to really tighten down the property and be able to have the property to be able to market and run as efficiently as possible. The property management, we do this in-house. Every value-add deal I've ever purchased has always had this in common. It's always have had bad management. So we take care of everything in-house in order to maintain the highest collection rates and the best quality tenants. The leasing process is also extremely critical. The lender, we take care of all communication, tax returns, K-1s, and also providing P&L statements to all of our investors. So I just want to briefly touch about deal structure. When we raise equity and raise capital for deal, the capital that we raise will be in use for a period of 24 months or less. So on a $100,000 investment, the interest generated would be $10,000 a year or $833 a month. We are looking to refinance the property at about 24 months after we've completed our remodeling and turning over the units. We will refinance the property and then fully repay investors back out. All the additional benefits that I'm going to go over in the next slide are going to be generated because equity is received in the deal, but you no longer have any capital in the deal. Once we've hit the refi mark. So these returns are being made in perpetuity, again, with no longer having capital in the deal. So each quarter we're going to be sending out a check for the monthly cash flow that's generated. If we go to refinance the project out in year 5 or 10, there will be additional cash that we will be able to pull out and then distribute that to investors. We're also benefiting from principal paydown, property appreciation, tax deductions, cost segregation tax benefits. When we go to sell the property down the road, the profits of that would also be divided up. And again, all these are being made with no longer having any capital in the deal. So the goal of this structure is to be able to put money into a deal. We'll refinance in year 2, and then you can take that capital, put it into another deal, so we can rinse and repeat, and every 2 years recycle the capital into another deal, another one, and taking a piece of equity out of each of those deals. Regarding how we figured out the equity piece, I'm just going to give this as an example. If we had to raise like $400,000 for a 36-unit deal, that $400,000 that would be raised would be granted 10% equity in the deal. We provide equity for any investments of $100,000 or higher. If any investments are under $100,000, we will still pay 10% interest, but we don't at that point give any equity up. Typically when we do these deals, if we're able to fully cash investors out and return all capital, typically that's where we're going to have a smaller piece of equity in a deal, like how we're structuring these. If we're doing deals where investors' capital are staying in the deals for 5 years, 8 years, 10 years, at that point they would have a much higher percentage equity because their capital is still in the deal, and that's typically how and why these are structured in this manner. So on a deal, for example, on $400,000 here, going back to that example, if one investor were to put the entire $400,000 in, they would take 10% equity. 2 years, it would get cashed out. If the $200,000 were brought in by 2 separate investors and they put $200,000 in each, they would each take 5%. And if we had 4 investors each putting $100,000 in, they would each take 2.5%. So we could just divide it up based on what makes everybody the most comfortable. Cost segregation is a benefit where we can go through and we can take all the depreciation of the property and accelerate everything into 1 year. So we're doing this prior to remodeling, so we can take that depreciation benefit on all the items that we'd otherwise be throwing away: appliances, flooring, cabinets, countertops. We will then remodel the property and do a second cost segregation. So there's a really significant 6- and 7-figure tax benefit that we can generate, that we also will divide that benefit up and distribute those to investors also. The current lending opportunity that we have right now is 164 units in the city of Shaker Heights and Cleveland Heights, an A-class market for sure. Our plan is to do a very light remodel, raise rents, and refinance out in less than 2 years. I've got a purchase price of $9.2 million. We have an equity raise of $2.4 million. I personally have $150,000 at this point of non-refundable earnest money in this deal. I've walked the units, I've walked the property. My lender has qualified the deal. We've reviewed actually 2 term sheets today, and we've selected one lender on that. And we have about 40 days prior to closing this deal. We're accepting investments either through cash or through self-directed IRAs. Here's just my contact information, my phone number again. Sorry this ran a little bit longer, but please call me. Any questions you have, love to get together, sit down, explain the deal more, and just anything else I can provide just to have a more, just a higher comfort level with me and the investment. So thank you for your time. Appreciate it.